Right, so today we're going to start the chapter on cash and receivables, chapter 7. Now, when you're thinking about cash and cash equivalents, I want you to really think about what is on the balance sheet. So when you see that line, the very first line under assets called cash and cash equivalents, that's clearly what we're referring to. But now to know exactly what could be in that balance, that's the focus of this slide. So obviously you have your currency in cash, so your dollars and coins, balances in the checking account, that is included in the bank statement. That would be included in your cash balance, and items for deposits such as checks and money orders from customers. So these things right here are really what you normally think about as a cash balance. You cannot forget about cash that is considered short term. This is highly liquid cash and investments that can be readily converted into cash. So something that you have sitting there that can be an easy conversion to cash. So we have money market funds, usually money markets, 30-day kind of money market funds, treasury bills. Again, we like to see that 30, 60-day kind of mark to consider it as a short-term cash equivalent, and commercial paper. So all of these other things can be included in your cash and cash equivalent balance on the balance sheet. Now, when we're thinking about cash and cash equivalent, I think that the internal controls over these balances are crucial because cash is such a high risk for theft area. So you really have to pay attention to the internal control structure when you're thinking about cash and cash equivalents. So some things to think about over these internal control procedures are cash receipts, so the money that you're actually getting in. You have to separate the responsibilities for receiving cash, recording cash transactions, and reconciling cash. So you don't want the same person, taking in these deposits, being able to go over to the bank and deposit them, and record the general ledger transactions, record everything that would go into the reconciliation balance, and also prepare financial statements. They have too much cash control, and there's a lot of opportunity to steal the cash. In terms of cash disbursements, one thing, you really should be paying all of your bills using a check. You really wouldn't be sending cash to a vendor or dropping cash off to the vendor. You really should keep track of things through check. Petty cash is the exception. A lot of times companies keep a small petty cash box for small types of things that they may need cash for, but generally you should be doing everything by check. Now again, this is separate responsibilities for these disbursements, so the person who's actually paying the bills, that should be different from the person who can sign the check, has check authorization, and then the person who's actually making the entries. Those should all be segregated because you don't want the same person who's paying the vendor being able to write the check to themselves and record the transaction. I mean, that would be a huge opportunity for somebody to get away with something. One thing that should really be kept in mind are signature stamps. So I've seen many times that the president of the company is the one who signs all of the checks, but they have a signature stamp that basically anybody seems to have access to. In theory, it's supposed to be in a locked box and only this person's supposed to sign it. But all of a sudden, I would see the accounts payable clerk using the signature stamp to stamp the checks when they were just the one who ran it through the system. So be very careful in organizations that have signature stamps. I can understand the need for them, but make sure that you have solid controls over who has access to those signature stamps. Now, with restricted cash balance and compensating cash balances, these are when you have to keep cash restricted for a certain reason, or maybe you have debt and the bank requires you to keep a certain amount of cash on hand. Compensating balances are the minimum balance that must be maintained in a company's bank account as support for funds borrowed from the bank. So again, the bank sometimes may require you to restrict a certain amount of cash and have a certain amount of cash balance when they're giving out these loans. got our FASB. You can read through that. Now we move on to accounts receivable. So this is really picking up where you left off in intro to financial accounting, where you know that you're going to have an accounts receivable balance when you've made a sale, but the person hasn't actually paid you the cash. Remember, all accounts receivables are classified as a current asset on the balance sheet, and the recorded net of trade discount. We're going to talk about a trade discount, which you may have seen also in financial accounting, but let's talk about it a little here. So here's how the cash discount looks, what the cash discount is. So here you have we call it 210 net 30. So what this means is if a company decides to discount their receivables, they're saying that you will get a 2% discount on your receivables if you pay them within 10 days. However, you're actually only required to pay them within 30 days. You could see something like, 115 net 30. Same type of thing. Here you would get a 1% discount if you pay it within 15 days, but you wouldn't have to pay it for 30 days would be the normal balance. So companies do this because usually they want to get the cash in quicker. They want to incentivize their customers to pay their bills more quickly. And why would the customer want to pay their bill more quickly? Well, because they're going to get a 2% or 1% discount by paying it more quickly. So they'll be able to save money if they pay it more quickly. All right, now there are two different methods to account for these cash discounts. We have the gross method and the net method. Let's turn to those to see how they're different in the recording of the transaction. So what we have here, October 5th, Hawthorne sold merchandise for $20,000 with terms of the 210 net 30. So for one thing, you have to figure out what the terms are. If you're working at a company who gives discounts, you have to understand that. Or if you're paying a bill that has discounts, you have to understand what those discounts are, because there's obviously an accounting implication, but also the opportunity to save money. So I would suggest, if you're working for a private company and they have accounts payable, figure out your vendors who have discounts so that you can make sure to utilize these discounts. And again, if you're the company offering the discounts, you must be familiar with those, because as you'll see with these accounting implications. So on October 14th, the customer sent a check for $13,720, taking advantage of the discount to settle $14,000. So $14,000 is what they had originally owed. And then on November 4th, the customer paid the remaining balance. So if it's a 210 net 30, the original transaction was on October 5th, but it was paid on October 14th. So it would fall into that 10-day window that they have to utilize the discount. Now, they didn't pay the entire bill, right, on November 14th. Let's look at the gross method first. So we had, on October 5th, okay, here, we're using this gross method, they had to set up their accounts receivable for $20,000 and sales revenue for $20,000. So this is a normal, these entries are very normal to what you're used to seeing, because here we see they made a sale for this $20,000. So on October 5th, they made their normal entry. Now comes along October 14th. Okay, we're down here. The customer sent Hawthorne this check for $13,720. So of course they're going to record the cash here for the $13,720. Now, they tell us that this is to settle the $14,000 amount of the bill. They're not paying the whole 20 yet. They're only paying the 14,000. So we're going to relieve the accounts receivable that we had originally booked up here for 20 in the amount of 14. Clearly, they still have another $6,000 to pay. What do we book to make this balance? This 280. And where does 280 come from? If you take the 14,000 times what? 2%, that's the discount that they're getting, you will come up to this 280 that they're booking. And here's a new account that you really have not seen before. We have a sales discount account here. The sales discount technically reduces the amount of revenue that the customer is, that Hawthorne here is recording. So sales discount is an income statement account. Please be familiar with that. So it will show up on the income statement, and usually you take first your sales revenue and then any sales discounts after. Sometimes companies would do sales net, so you know the discount is included in that sales number, or you could report it as a completely separate line item. So hopefully that makes sense of the accounting for these. And then what happens on November 4th? Well, November 4th came along and the customer paid the remaining balance of $6,000. So we can see the transaction that they recorded down here, just your normal entry. They paid $6,000 and they're reducing the remaining $6,000. So if you're thinking about it in a T account here for accounts receivable, the $20,000 went in, then the $14,000 came out, and then the $6,000 came out. So we're good from a T account standpoint that for the AR everything has cleared out, even though now we know that they did record this discount here of the $280, because we know they did not pay $20,000 in cash. So that's one method, the gross method. The next method is the net method. Now under the net method, Hawthorne Company is going to book the transaction as if they've known that their customer is going to utilize the discount. In the gross method, when they first booked the entry, they didn't consider the discount. Under the net method, you consider the discount as soon as the transaction has occurred. So they're going to book their sales revenue of $19,600 based on the $20,000 times the 2% discount, and then record the rest in accounts receivable. Now, under the same exact situation that we just saw, the customer comes in and pays $13,720 to settle the $14,000 balance. So this is still based on taking $14,000 times 2% and then relieve the accounts receivable accordingly. Now, the problem is they didn't pay the entire balance on October 14th. They only paid enough to settle $14,000 of the $20,000 balance. So same thing comes along November 14th. They pay the remaining $6,000. You cannot credit $6,000 to accounts receivable because $6,000 isn't remaining in accounts receivable. Only $580 is sitting in accounts receivable at this time, right? Because when they did their entries, they had booked $19,600 first. They paid the $13,720. Remaining is only $5,880 because they're already considering the discount. So they're only going to relieve the accounts receivable for $5,880. And then we have this new account, interest revenue, which also shows up on the income statement. So this 120 is essentially increasing revenue, right? Because they didn't utilize the full discount like they thought they were going to on October 5th, because by the time they used the discount, they had only paid $14,000 and they had a remaining $6,000 to pay. If they had paid all, in this case, $19,600, the entry would have been done right on October 14th. But because they didn't pay enough, and by the time November 4th came along, they had exceeded their 10-day window to be able to get this 2% discount, they were forced to pay back more than they could have if they had paid everything by October 14th. So both of these methods, gross method, net method, are acceptable under GAAP. It's another choice, a choice that you have in which accounting principle makes the most sense. Personally, I would be using the gross method because you're never really sure if a customer is going to be recording or utilizing the discount or not. So I personally think it's easiest just to not record it and record it when it does actually happen. Now we have sales returns to consider with accounts receivable. So with accounts receivable, you have to remember people return things. So you have to consider a customer may be returning a portion of the sale that was made. So when we're looking at how to come up with the entry for a sales return, let's look at it in this problem. So during the first year of operations, Hawthorne sold $2 million of merchandise that had a cost of $1.2 million. So this is your sales, the $2 million, and this is your cost of sales, the $1.2 million. The industry expected the industry experiences a 10% rate of return. So the expectation is that of the $2 million that's sold, 10% of it's going to be returned. This is based on historical data. During the year, $130,000 was returned prior to customer payment. So $130,000 was actually returned. You have to now record the returns at the end of the year and make any necessary adjustments. Okay, so now to record the entry, you have to record the actual returns that happened. So what were the actual returns during the year? 130 is what actually was returned. So you have to reduce your sales with the debit, reduce your accounts receivable with a credit, because you've got to get the sale out of there, you've got to get the accounts receivable out of there. Now, you are putting amounts back into inventory based on this 60% margin, right? So you had, if you're thinking about it like an income statement, you had $2 million. You had $2 million sold. It cost $1.2 million. This $1.2 million is 60% of the total. So when you're thinking about, where the 60% comes in of how much you're going to record back into inventory, it's got to be 60% of the 130. So if you take 130,000 times 60% is where you get the 78 from. So you're putting it back into inventory, and then you're putting it back into your cost of goods sold. So you're reducing your expense with the credit. So you need to know this entry, how you book a return. Now, you can't forget what the industry usually experiences, is the 10% rate of return. So these actual returns are what happened at the end of the period. However, we still have to consider a 10% rate of return. So we do have an adjusting entry at the end of the period. Where does the adjusting entry come from? Well, if you take the 2 million times 10%, you end up getting, let's do it out here, 2 million times 10% is 200,000. I have to use this pen. I moved it to the thick model. I don't know how to change it. Nicole Mitchell, you'll have to help me there since you're an iPad expert. Oops. So let me get rid of that. So here's my thick pen coming off. We said, again, doing 2 million times the 10% gets us 200,000. Well, we've already booked 130,000, so we can take the 130 out of the equation. That leaves us with 70,000 that we still have to book because we think that the estimate is correct at 10%. So this is where the 70,000 is what we're going to book for the sales return. Same exact entry that we booked for the actual return, but we're adjusting the entry to increase it based on historical data. Now, if actual returns were as high as expected, you don't have to book an additional entry. And if they were higher, you don't have to reduce the entry because that's clearly what the actual entry was. And so again, you're going to reduce your sales. Now, this allowance for sales is similar to your allowance for doubtful accounts. We're not going to reduce accounts receivable. Sorry, I said it was the same entry. I lost my thought there for a minute. You're not going to book it to accounts receivable because you don't know what's going to be written off yet. You're going to have it sit in this reserve account, this allowance for sales, which is similar to your allowance for doubtful accounts. So it's going to sit there until you actually make the return. But you still do have to adjust your sales at this time. Now, this 42,000 is based on taking the 120,000 times the 10%. That comes out to 120,000, right? So the 1.2 million times 10% gets you to the 120, and then you have to take out what you've already booked, so the 78 deduct to get you to the 42 here. Now note here, we are going to reduce our cost of goods sold, so we're going to reduce the expense in this period, but we're going to have it sit in this inventory estimated returns account until the return has actually happened. So this is for any sales return. You have to go through the process of what your actual returns were, what you estimate the returns to be, and book the discount to set up allowances for what you think the returns are going to be based on historical data. Now this should be familiar when you have an uncollectible accounts receivable resulting from credit customers who are unable to pay the amount they owe regardless of the collection effort. Now, I'm not going to spend a significant amount of time on this because you should have seen this in your financial accounting class before. When you have an uncollectible account, you have to book the expense in the period that the revenue has been booked because of the matching principle. So you're going to book it to this bad debt expense account and then the allowance to let it sit there until you actually do have to reduce the accounts receivable. Now, when you go to reduce the accounts receivable, I figured out how to make my pen smaller. That's good there. When you actually reduce the accounts receivable, so a customer has actually said, we're not going to pay the bill, or they just determined that they're not going to get this money back, you're going to debit this allowance account and credit what? We're going to credit the accounts receivable. So let's see a couple of examples of that. But this is a very, very basic entry that you need to just very, very much know. So here is how it looks on the balance sheet. So remember, the accounts receivable is a balance sheet account. The allowance is a balance sheet account. A lot of times on the balance sheet, you'll just see AR net. When you see that, you must know that the allowance for doubtful accounts is included in that account. Now, we call this method of setting up this allowance, it's called the allowance method. And under this method, there are two approaches that you can take to actually come up with what you think the best estimate would be. And we call those approaches the income statement approach and the balance sheet approach. So let's see what those look like. Now, under the income statement approach, you focused on past credit sales to make an estimate of the bad debt expense, with again the emphasis on this matching principle, so that you have the sale, the expense of what you anticipate the amount of sales being uncollectible will be is recorded in your allowance. So you take the sales, and then you come up with an estimate of what you think the bad debt is going to be. So maybe you think it's going to be 2% or 1% of sales. That's how you determine what the estimate of the bad debt expense is going to be. An example. In this company, Musicland had credit sales of $400,000 and estimates that 6% of credit sales are uncollectible. Sorry, not 6%, 0.6%. So you simply take the sales times your estimate. Remember when we talked about estimates, this is an estimate. It's not exact. Maybe it'll be 1%, maybe it'll be 0.40%. We don't know, but the history tells us that generally 0.6% of sales are not collected. So we come up with $2,400. Now, one thing to remember when using the income statement approach is that the full amount that you've calculated is what will go into bad debt expense. If there's already something in your allowance, that's okay. You're going to add this right on top. Whereas we'll see in a minute a different approach that's treated differently. So that's a really important point to remember. Whatever you calculate using the income statement approach is what will be expensed and added to your allowance. Now the next approach we have is the balance sheet approach. Now the balance sheet, you're using the accounts receivable balance to come up with this. So that can come from the accounts receivable aging report. And what you can see here is you have what your desired balance is less any existing balance. So when you calculate this balance, that's what the desired balance is going to be, but you have to subtract it from any existing balance to come up with what your estimated bad debt expense will be, and therefore how much you're going to add to your allowance for doubtful accounts. So here's an example of the balance sheet approach. So they have $50,000 in accounts receivable and $200 credit already in the allowance for uncollectible accounts. Past experience suggests that 5% of receivables are collectible or are uncollectible. So if you're trying to figure out what the bad debt expense is going to be, how are you going to calculate this? You're going to take the $50,000 in accounts receivable and multiply it by the 5%. So now again, if you multiply 50,000 by 5%, you get 2,500. However, you can't forget when you're looking at the balance sheet approach, you have to consider what is already in your allowance for doubtful accounts account. So it tells us, make the allowance, and this is just wording. They're calling it allowance for uncollectible accounts. I call it an allowance for doubtful accounts. It's the same thing. I'll say allowance for DA, doubtful accounts. Already in there is this $200. We need our ending balance to be $2,500. So how much do we have to include in our allowance for doubtful accounts? Another $2,200. I'm sorry, $2,300. Okay, so the entry that you're going to make, it's asking you what the bad debt expense needs to be. You would have your debit to what? Bad debt expense. And your credit goes to your allowance for doubtful accounts. For how much? The $2,300, not the $2,500. So don't get that confused when you're figuring out what the balance should be. Under the balance sheet approach, you have to consider what's already there. Under the income statement approach, you don't. Your calculation just gets strictly added to the allowance, even if there was already a beginning balance. So you can see everything that we had just done right here. Now, to give you a little bit more detail with the balance sheet approach using the aging of receivable balance, so before you saw just a straight 5% of accounts receivable, you can use the AR aging report. The AR aging report is a report that companies use to keep track of who owes them what. So let me see here. If I add a page, I'm going to try to do this. Hold on just a second. We have the year-end accounts receivable is broken down into these age classifications. So that's what I was talking about. Each age grouping has a different likelihood of being uncollectible. And you compute the required uncollectible account using this amount and compare the uncollectible account with the existing balance in the accounts receivable, as we've talked in the allowance for doubtful accounts, like we've talked about before. All right, so if we come up with our own AR aging report and we use, let's call this intermediate 1 AR aging. You'll have to excuse my writing on here. I'm getting used to using the stylus and it's a little bit messy, but we'll include, let's say this is going to be Nicole's real estate firm. Okay, and Nicole has each of you as clients. So we've got Sam and Megan, Erin, Sequoia, Dewey. Okay, so how this works, if we were to set up an aging report, it has these buckets. So 0 to 30 days, 31 to 60 days, 61 to 90 days, 90 plus days. So each of you are, oops, we forgot to include Brittany as a customer. Sorry, Brittany. Brittany. Each of you are a customer of Nicole's real estate firm. So she's done some kind of service. She's, come in and has redecorated your homes or whatever the case may be. You owe her money. Now, the AR aging report is trying to determine how long you owe, how long you've owed her this money. So let's say Sam owes her $1,000 and it's 61 to 90 days past due. Megan's current. The bill was just issued. Erin has been outstanding for 90 days. So we're starting to get concerned if Erin's going to pay her balance. Sequoia just owes her $100. She's a little bit past due, especially if Nicole's invoice period is a 30-day period that she likes people to pay their bills. Twee is current. She just owes $100. And Brittany, is a little bit past due. So again, what this AR aging report is doing for Nicole's real estate company is listing who her customers are. So now each of you are her customers, right? How much you owe to her and how long you've owed it for. So this is called the Accounts Receivable Aging Report. So every company has this. When I was an auditor, we would be very, very concerned about the companies who are really in this past 90-day category. They haven't paid for quite a few months. Are they going to get paid? Now, how this can relate to the allowance, let's go back to our slide here. We'll move on from that. We'll also add Natasha down here as the most current customer. So current, didn't include that column. There would be a current column up here called current. So we'll move on. Okay, so here's another example of an accounts receivable aging report. They have it flipped a little bit where these days are just listed when they're current and it's not by customer, how you would normally see it, but they're just trying to show you a summary of their balances. So this is just a summary. It's not listed customer by customer. So they have $45,000 for current and then up to $67,000 total. Over 60 days is $2,000. Now this is what they're using for their estimate of uncollectible account. They're saying we think, based on history, 1% of our current balance won't get paid. 3% of our 1 to 30 days won't get paid. 5% of 31 to 60 days won't get paid, and 10% of over 60 days. Now they're coming up with this new allowance balance of $1,350 is how much they say the ending balance needs to be in their allowance for doubtful accounts. Remember, this is an estimate. We don't know for sure who's going to be not paying their bill, but based on history, we do have customers, unfortunately, who don't pay their bill. So this is what our ending balance of the allowance needs to be. But in this case, there was already a balance of $500. $1,350 is what the ending balance needs to be, so we only have to add $850 to the allowance balance to get to the ending balance of $1,350. And then again, you see the entry, debit bad debt expense, credit your allowance for uncollectible accounts. So I can't stress to you enough how important it is to make sure that you understand the allowance method. So again, we're trying to match our expenses by booking it to the bad debt expense to the revenue that we've actually earned during the period. To say this revenue that we're getting, we think this much of it won't be collected. And then the different approaches, the income statement approach and the balance sheet account approach. And definitely the entries. Okay, so to book the expense, book the allowance, please do not forget about the entry that you end up making when you actually determine that there's going to be a bad customer. So now at the end of the year, you've got more customers in that 90-day category, and they've told you, listen, we're having a real hardship. We're not able to pay our bill. We'll never be able to pay our bill. I'm really sorry. So what is the entry that you're going to make when that happens? Let's say their bill is for $500. You're going to debit your allowance, because you've set it aside now, right? Allowance for doubtful accounts for the $500. And what's the credit going to be? It's going to be AR. You need to get it out of your accounts receivable balance. Okay, so please make sure that you're very comfortable with how this entry flow works. How you set up the allowance entry, how you end up writing it off when you determine that there is a bad debt. So now you see here's the entry that I just referred to in the previous slide. When an account is deemed to be uncollectible, a journal entry is made to record the actual write-off. So again, you're reducing your allowance here and reducing the accounts receivable because that account won't be collectible. Now, in the event a customer makes a payment after an account has been written off, so, they say, sorry, we can't, and then you stop doing business with them, and then they miraculously come into some money and pay their balance, what do you need to do? Well, you're going to reinstate the accounts receivable first. So remember, you had originally written it off. So, reinstate it. Basically, you're just reversing this entry to get it back on the books and replenishing the allowance, because you're certainly not going to book any more revenue or any of that. You need to put it back into the allowance account. Then what has actually happened? This would be your normal entry if you never wrote the balance off to begin with. A customer gives you cash, you debit the cash, and then you credit your accounts receivable like you're used to seeing. So in the event that this happens, which it could very, very well happen, this is what you would do. Now, there's another method called the direct write-off method. Remember, we've been talking about the allowance method. We have a direct write-off method. So if an uncollectible account is immaterial, bad debts are simply recorded as they're incurred without the use of an allowance account. I really don't like this approach. This method is not GAAP. Luckily, in this example, they're saying if the amounts are immaterial, you can do this. But I really would like to take a stance and just say not to use this direct write-off method at all, because, again, it's not GAAP. But in the event that, you have an employer that says the accounts are immaterial, we're just going to write them off. If you have these immaterial accounts, you would just post directly to your bad debt expense and directly to the accounts receivable. But if you're doing proper accounting, you should have an adequate allowance set up. I did work for a company that when I first started there, they did not have a proper allowance set up. And when I went through their receivable accounts, there were a bunch that were bad accounts that needed to be written off. We didn't have a proper allowance. So I couldn't make the entry to debit the allowance and credit the accounts receivable when I wanted to write them off, because there wasn't enough in the allowance pot. So I did have to do this direct write-off method. I mean, if you haven't been doing proper accounting and estimating what you think your bad debt is going to be, then you would have to resort to this direct write-off method. This is something that I would disclose in the financial statements, because you're going to have a huge, especially if it's not immaterial, you're going to have a big bad debt expense when previously you wouldn't have, because you've never hit your bad debt expense before. So just please know that direct write-off method is not GAAP, whereas the allowance method is GAAP, because you're matching the revenues, you're coming up with an estimate and booking the expense that you think the revenues in that period are going to be bad. Whereas this, you're just, as soon as you come across one, you're just booking it. Now, if you don't have enough allowance set up, let's say you were trying your best to come up with these good estimates using the allowance method, and you just had a bunch of bad accounts, especially in the economy that we've been faced in for the last really almost 5 years now, we probably are seeing more and more of this type of entry happening. We're hitting bad debt expense directly because there are just customers that are going out of business, can't pay their bill. I would imagine more so than in the past. So now we're going to move on to another concept. So, as most of you have already heard me say, this intermediate class and some of these chapters are a mile long, an inch thick. We're covering a lot, but I really don't think any of these topics are extremely new to you. I think some of these things you have seen in financial accounting, and hopefully you don't find them too challenging individually. So we're moving on to a notes receivable. Remember, we've been focused on cash, then what's going on with discounts, accounts receivable. Now we have notes receivable. So a notes receivable is a promise to pay a specific amount at a future date, right? So let's jump right into this. So most notes are interest-bearing notes. So somebody lets you borrow money, there's going to be interest attached to it. Why else would they let you borrow money unless they're going to make some money off of you borrowing the money? This is what banks do, right? If you're given a loan, they're going to charge you interest on the loan. So when we talk about interest-bearing notes, that's what I'm referring to, a loan that has an interest rate attached to it. So in this example, on November 1st, 2014, West Inc. loans $25,000 to WinCo. Okay, $25,000. The note bears interest at 12%, and it's due on November 1st, 2015. So they're asking us to prepare a journal entry on November 1st, December 31st, and November 1st, 2014 for West. So the entry that you're going to make on November 1st, when the note was first issued, is your notes receivable. Now remember, your West company. So we're saying for West. When you're reading through these problems, you have to make sure that you know who you are on the problem. Are you West or are you Win? Are you giving the money or getting the money? In this case, you're West and you're giving the money. So you can see on November 1st, they're paying out cash of $25,000 and setting up a notes receivable because somebody owes them the money back, right? Now, Win Company would have set up, what would they have set up? On November 1st, they would have debited what? The cash for $25,000 and credited what? The notes payable for $25,000. Right? So you don't forget who's who. This is West. This is Win. Okay? So now we move on, and they want us to book the entry for December 31st. So December 31st, 2014, what happens? Well, you should remember from Chapter 2, with our adjusting journal entries, we have to book some kind of interest now. Okay? So how are we going to book this interest? It goes back to your adjusting journal entries. How are we going to book it? So if $25,000 was the loan balance, we have to multiply that by the 12% and understand how long this loan period is for. So it's for a 1-year period from November 1st, 2014 to November 1st, 2015. It was incurred on November 1st. We've got November 1st, so the month of November and the month of December. So we're going to multiply it by 2 divided by 12, so everybody should feel comfortable with this entry, and you should come up with the $500. So this, again, is an entry that you should have seen in our adjusting entry process. Now, they're going to book the interest receivable because they haven't actually been given the interest yet. They won't get the interest until the end of the loan period. And then they're going to book revenue at the end of the year because they've earned it. They just haven't received that interest revenue yet. So again, an entry that you should feel very comfortable with already. Now, what happens on November 1st? Win is going to pay West the entire balance because the note is due on November 1st. So if you're not sure where to start, you don't know exactly how much cash you should be recording, let's start with what you do know. If they're going to pay off the entire note balance, you have to credit your note balance, right? You had it as a debit, you have to take it out of there. If they're paying the interest, you have to reduce your interest receivable. So it was a debit, you're going to credit it here. So that's taken care of. How do we come up with the rest of the interest revenue? Well, now we have the $25,000 times the 12% times 10 over 12 should get you the $2,500. So you've got $2,500 there. Put a few 2 extra zeros there. $2,500. So that's that. These are all the credits. A little misaligned on this slide. So you book the $2,500, and then you can basically plug the cash if you want. So this entry should be very familiar. Now there are also non-interest bearing notes. Do not bear interest. Interest is deducted from the face value of the note. Cash proceeds equal the face value of the note. Now under GAAP, there's a concept thing that says there is no such thing as free money. Okay, so this is a GAAP thing. They say you can have a non-interest bearing note, but there's no such thing as free money. The other term to get the interest on the books that you need to be familiar with is, we call this imputing interest. Okay, so if you have a non-interest bearing note, maybe a company is just being very kind to you. Maybe you're a nonprofit organization and they say, we're going to let you have this note almost as if we're investing in you in a sense, but they're not getting a reward for it. But they believe in your mission and are just going to let you borrow money out of the goodness of their heart. It can happen, believe it or not. But again, GAAP comes in and says, nope, you have to record interest on the books. You have to impute the interest. All right, so here's an example of a non-interest bearing note. So we have West and Win again in a completely different scenario. West accepted a $25,000 non-interest bearing note from Win as payment for a sale. So in this case, you're West. You sold something to Win. Instead of Win paying you, you issued a notes receivable for them to pay you at a later date. This is treated differently than an accounts receivable because of the period of time that we're talking about. It's not due until December 31st. It's an actual physical note that they're issuing with different legal terms than accounts receivable would have. So this is a different situation than just a normal accounts receivable. So you set up the notes receivable because they will pay you the $25,000 on December 31st, 2014. Now, this discount on notes receivable is the kind of different thing here. So the FASB says, hey, we're going to let you pay it. We're going to let Win pay you at a later date, but that's really part of the sales price. So you need to impute the interest on this sale for 12%. And 12%, let's say it's usually the prime rate that you are charging interest. So whatever the market's yielding for normal interest rate is how you'd impute this interest. So you'd have to go to the Wall Street Journal or look on different websites to find out what the rate is at that period of time that you've issued the note. So again, the FASB says, hey, West Company, we can think that this is out of the goodness of your heart, but there's got to be something kind of in it for you. And what's in it for you is that the sale was really $22,000. You're letting them borrow the money for a year and in theory charging them interest, even though you're saying it's a non-interest bearing note. It's really part of your $25,000 sale price. So this is something that each of you should keep in mind when you see these 0% financing agreements, let's say at furniture stores or computers or cars, where it's like 0% for a year. Well, it's really rolled into the price of what you're buying. So somebody, in the back room has calculated this to say, let's see how we can finagle this to look like they're getting it for free, borrowing our money for free, and getting the product. But they're really not, So you need to keep that in the back of your mind when you're on the side of getting these 0% type deals. So again, in this case, the FASB does say you have to reduce your sale revenue and impute the interest. So it's a discount on the notes receivable. This discount on notes receivable would sit on the balance sheet. So you're allowed to sit it on the balance sheet and only record the sales revenue of the $22,000. Okay. Now December 31st comes along and Win Company actually pays the $25,000 that they do for whatever sale was made. Okay. You're now able to reverse the $3,000 that was originally sitting as a credit on your balance sheet for the discount. You're going to book it as a debit just to reverse that. you're going to reverse your notes receivable to get it off your books. So they've paid the whole notes receivable account. Now you're able to book this interest revenue. So in the end, you still get $25,000 on your income statement, but you can't just take the $25,000. $22,000 is the sale. The remaining $3,000 we're saying is technically interest revenue, even though technically there was not interest on the note. So if you're confused, replay this slide because, it's kind of tricky to think through, but the rules say even if you have a non-interest bearing note, really there is some interest attached to it. When I use the example of companies maybe just letting other, say, nonprofits just borrow money, that's a little bit differently treated if a service isn't attached to it in terms of the accounting. But you would still, in that case, need to impute an interest rate because, again, there's just no such thing as free money. But this type of transaction is more realistically what you're going to see when you have these non-interest-bearing notes. And again, perfect examples are these furniture companies, computer companies, credit card companies. Some cars now have 0% financing. So remember, really the FASB says, nice try, but we know it's really part of your revenue balance. So you still have to record some interest revenue. Now, another concept that comes along with the accounts receivable is this financing with receivables. So companies may use the receivables to obtain immediate cash. We call this factoring. So we would let a company buy our receivables and they give us cash, we give them our receivables. And here's a really nice slide that shows that. All right, so this is the slide that I want you to know when it comes to factoring. Don't worry about those other slides that I have in here. So the way that a factor would work is that you are the retailer, okay? You're buying something from the supplier. So you're buying it on accounts receivable. So the supplier now has the accounts receivable. You're getting the merchandise. Okay, so that's a normal transaction that you're used to seeing. Now the supplier has this accounts receivable, but they need cash. So they're going to sell their accounts receivable to this factor. And the factor is going to give the supplier cash. Now, the retailer actually has to pay the factor the cash for the accounts receivable. So it's a financial institute. A factor is a financial institution that buys receivables for cash. They handle the billing and the collection of the receivables and charge a fee for the service. So again, the factor, what's in it for the factor is that they're making money off of doing this. They're giving money back to the supplier. So companies would do this, especially when they're in a cash kind of crunch. So again, when it comes to understanding this factoring, I really want you just to understand this idea. Don't worry about the journal entries that you've seen in the slide package. I'm going to skip through this. Don't worry about the accounting for these. Oh, I might have pulled out the slide. I'm sorry about that. All right, so that's everything from Chapter 7. Hopefully you're able to follow along in this type of format. And please email me with any questions. What we will do on Wednesday is go over the homework from Chapter 7 so that you're really comfortable with it. As a reminder, there will be an exam from Chapter 5, and I still owe you the completed contract write-up. So I'll walk you through those steps so that you're comfortable with that. But the quiz, you should be familiar with the problem that we solved in class, not the general entries, but the actual just percent of completion, how you come up with how much gross profit you should be recognizing based on a percent of completion. So please email me if you have any questions. Thank you for listening. Have a great weekend, and I will see you on Wednesday.